Hi everybody, this is Lance from ThetaTraders.com. This video I'm going to go over position sizing using the law of large numbers and determining a good system to figure out what is the max loss you could lose on a certain trade depending on the size of your account. Let's get right to it. Risk management. I'm going to go over a 3% rule, although this percent can be up to your risk tolerance, so it could make it higher or lower. And I'm going to go over why 3% is a reasonable number that I typically work with, and also the psychology of using frequent trades. So today we're going to talk about one of the most important but often ignored parts of trading, risk management. You might be a pretty good trader and you do a lot of good trades, but let's say you have one bad trade, but your risk management was off and you're risking 20% on your whole account on one trade. If that doesn't work, that's going to be a pretty big net loss on your account. So you could have the best entry signals and strategies in the world, but if you don't manage your risk correctly, you will eventually blow up your account. 3% rule psychology. What I would recommend is to never risk more than 3% of your total trading capital on any single trade. So for example, you have a $10,000 account and you multiply that by 3%, the max loss per trade would be $300. That doesn't mean that you're going to use $300 on your trade. That's just how much you're able to lose on a trade. Now let's say you do a credit spread where it's a 5-with spread. You're using $500 minus the credit you take in. And let's say for the math, you get $50 in your credit spread. You would only be using 500 minus 50 or $450 on your trade. However, let's say you have a 3x stop loss. So if you enter at 0.5 and then you stop out at 1.5, you have a net loss of $100 in that case because you took in 50, you lose 150. In this case, if you lost $100 on a trade and you have a $10,000 account, you could take up to 3 of those credit spreads because 100 times 3 is $300. So reasonably in a $10,000 account, if you took in $50 in credit on a 5-with spread, you could take 3 contracts of that spread if you're following the 3% rule and you're stopping out at 3x your premium received. The math behind the risk, let's say you have a losing streak where a few trades in a row are losing. If you took 5 trades and every one of those stopped out with a 3% loss times 5 trades, you would have a 15% drawdown on your account. Let's say that you were doing it where instead of a 3%, you had a 10% loss per trade, and then you take 5 losses, then you're down half of your account, and that'll be really hard to recover from. If you recover from a 50% drawdown, you need a 100% gain just to get back to break even. So $10,000 account, if you lose 50%, you're at $5,000. You need to get a 100% gain on the $5,000 or to double your account there. Capital preservation is priority number 1. You want to make sure that you're lowering the amount that you're willing to lose on any one trade. Now, this is a 3% rule for a small to medium size account. I think that's reasonable. You could go lower than that, especially if you had a large account. I would probably go 0.5 or even 1% of your account. It's very hard to make trades where it's a low percent if you have a smaller account though. So I think up to 3% is a reasonable number that you should be using until you have at least $25,000, $50,000. Then you might want to lower that from 3, even less, because you don't want one loss to be a big loss in your account. Now, psychology of losing trades. Losses hurt more than wins feel good. If you ever go to the casino and you make $100, you feel okay. But let's say you lose $100, you usually feel a lot worse than how happy you were if you won that money. What happens with big losses is you get revenge trading. Like, I need to make this back, so I'm going to do another trade that's going to make me break even. But then you may not be following your actual trade mechanics or why you took the trade in the right reasons. And then there's a possible greater chance that it may not even work out, which just amplifies your losses even more. Doubting your system, let's say you take a couple of losses on a trade, you might think that, oh, this strategy is not going to work. You need to do many, many trades, hundreds, even thousands of trades with a certain trade mechanic to see if your system is working or not. If you have a very big, let's say 10% loss on your account per trade, you might only do a few trades, you're down 30, 40%, and then you're doubting your system thinking it doesn't work. Where in reality, if you just had a smaller, say 3% per trade stop out, then you could take those many hundreds of trades and then see if your strategy is working or not. Also, over leveraging to recover. Let's say you took quite a bit of initial losses, you might take an even bigger trade. So if you're doing a 5-whiff credit spread using, say, $450 in your account, and then you're taking a 10% loss on that, then $10,000 account, you might be losing $1,000 on a trade. You might over leverage and then add more contracts. However, if you do that, then it's an even larger than 10% loss because you don't have the same account size as before the loss. Small losses reduce your emotional spikes and decision fatigue. So one of the things that we are doing when you're trading is you don't want to be showing emotion when you take a trade. You should be perfectly fine with a trade stopping out and just moving on from it. If you're feeling bad, like, oh no, this trade's not going to work out, I'm not going to be able to put food on the table, then you're sizing way too big. Why having a lot of trades helps. Let's just look at sample size and probability here. Edge appears over a very large sample size. If you take, say, 3 trades, that's just noise. Maybe the 3 trades worked and you think this is the best strategy ever. Maybe 3 trades lose and you think this is a horrible strategy. Doing, say, 100 trades, that shows the long-term outlook on it. A portfolio of many small, highly probable trades, less statistics work in your favor. So let's say you flip a coin 5 times. There's a pretty decent chance you could get 4 heads and 1 tail. However, let's say you flip the coin 500 times. The odds of getting 400 heads and 100 tails is pretty much impossible. You want the law of large numbers to work on your favor. Here's a practical application, 3% rule. Let's say you're dealing with stock. You have a stop at $1, max loss $300. That would be 300 shares. I would recommend using risk-defined trades. If you have undefined trades, like say a naked put, then it could technically be higher than what your percentages are. If you're doing a credit spread, you know what your max loss is. Iron condors, protective puts. If you buy a stock and then buy a put with it, you are limiting what your max loss is, because if the stock goes down, your put actually goes up. OCO orders, you can take a profit or stop out at the percent that you're willing to lose. Having that win rate plus a lot of small losses could mean long-term consistency. Final thoughts, you want to keep this stuff boring. Best traders are just system followers. Keep your losses small, keep your emotions in check, let the time and probabilities work for you. Key parts of risk small, trade often, and stay consistent. So if you found this video, let's click a like, subscribe to my channel. If you want to see how my trades work, I do a lot of defined risk trades. You want to check out thetatraders.com, and then you can join our community of disciplined traders. Have a good rest of the trading day, and I'll see you on the next one.